Rob Tatro, Portfolio Manager with Canaccord Genuity Wealth Management, and myself, Tanya Tatro, Advisor with Canaccord Genuity. Rob and I are going to talk today about RRSPs, TFSAs, and all of those questions that you might have, seeing as it's tax season. But before we jump into it, let's see how everyone's doing. So, Rob, you had a wonderful event this weekend. I think that our viewers would kind of want to hear about it a little bit, because I'm feeling like a little bit envious of what you were able to experience this weekend.
Yeah. Okay. Well, I ran a 50-mile trail race in Houston, Texas. So I got into a plane. I went down there. I did my first ever 50-mile race. It took me 9 hours and 17 minutes to complete 50 miles in the middle of the bush at a Huntsville State Park just outside of Texas. And it was the hardest thing I've ever done in my life. It was so difficult, so hard. I'm very, very proud that I finished, but my goodness, it was hard. Those miles were so hard, 50 miles. How about you, Tanya?
Well, I also had a run because there's a reason why we're doing these hard things, right? So we have a big event coming up in May. It's Run with Rob. I'm actually going to be joining as well. I'm kind of still deciding whether I want to do 1 half marathon or more than 1 half marathon. But for those of our viewers who haven't heard yet, Rob is going to be running 2 half marathons a day for, is it 12 days, 2 weeks?
12 days, yeah.
That's coming up in May, Run with Rob, and that's for the Canadian CMB Foundation. So I'm sure you want to talk a little bit about that, but that's why we're doing these hard things. That's what we're training for. It's really cool because the whole office is kind of in on this, and we're all training for it and looking forward to it. I had an awesome run this weekend. I'm about like 3 or 4 weeks ahead of my training. So I was feeling a lot of energy. I was going to run 10.5 miles, but I ended up running 11, and I ended up running it at a faster pace than I was expecting. So things are looking up. I'm coming for you, Rob.
That's impressive, Tanya. Like, congrats. I mean, you're not overweight, so you didn't have to worry about that part. So you've always been fit. You've always been a natural. I'll say, well, no, we've argued about this in the past, whether you're a natural athlete or not. But regardless, you've always been fit. You've always had good cardio. So I think you're natural. It turns out you're a natural at this. You didn't think you were, but you are, right?
Well, we'll see. We'll see, because the problem is I also want to put some kilograms on my deadlift and my squat while I'm training for this. So we'll see if we can do all of these at the same time.
Details.
Yes. All
so
right.
Run with Rob is our socials. If you're not sure, go online. I'm looking for people to run with me. Pick one of the half legs. They're all on there. Run one of them with me. Sign the petition, donate, or sponsor. Is what we'd love for you guys to do.
Yeah, come on out with us and go check out Run with Rob. Now, for today, I guess we can start talking about the more serious stuff here today. Today, we're going to be talking about RRSPs, TFSAs, the deadlines, strategies, all of these things. So we'd love to take your questions. We're live on all the socials today. So make sure that you just go in, add a question in the comment section on whichever social that you're on. Ask us all your questions about RRSPs, TFSAs, tax season, testing. We're happy to answer.
That's why we're here, right?
That is why we're here. So maybe we should start with just kind of deadlines here and timeline for what's going on right now in the world of RRSP and TFSA contributions. So first big deadline is, should we start with, yeah, perfect.
There you go. I got a slide for you. We got a slide for you all built up. So the RRSP contribution is always 60 days after the 60th day of the calendar year. So in a year where there is no leap year, it's always going to be March 1st is your deadline. So that's the date you have until that day to either deliver a check, give instructions, or I guess there's a couple other ways you could do it. But basically the transaction has to be completed by March 1st. You can also mail checks, I believe, and you can get it post-stamp. But regardless, our ESP contribution, there's no deadline for that. It's the calendar year. The TFSA contribution, same thing. There's no deadline, although you accumulate the contribution room every single year. Your personal tax filing this year extends to May 1st. So that's for you to file your taxes. If you're self-employed filing, you get until June 15th. And your tax bill is due at the same time as your tax filing, May 1st, 2023. So those are some important dates that I want to share with you guys to start. Tanya, anything you want to add to that?
Well, I think in terms of timeline, because of the fact that at this time of year, we said, okay, there's no deadline for TFSA, but this is the time of year that you want to be thinking about these things. So you want to be thinking you've just on January 1st, 2023, you've just accumulated another 6,500 of contribution room in your TFSA. So any cash lying around, anything that's invested in a non-registered account that's not currently growing tax-free, you may want to consider those contributions on that end. And the longer you wait, then the more you lose out on this tax-free status that you've got on these funds. So you want to start thinking about that right away. And then the other thing is for March 1st, the RRSP contributions. So at this time of year, we have a little bit of a better idea what income was for 2022. And we want to also start thinking about how we want to allocate any surplus. Do we want to put it in an RRSP? Do we want to put it in a TFSA? So maybe we start with TFSA, chat about that a little bit.
I pulled up the slide for TFSA. So let's start with that. So you mentioned the $6,500 contribution room. That is inflation adjusted. So every year, there's an inflation adjustment. And when it rounds up to $500 of inflation, they round it up to 6,500. So we just got an increase to 6,500. It probably won't be 7,000 for, I don't know, 3-4 years, something like that. But right now it's 6,500. So that means 88,000 cumulative. Remember, you don't get a deduction when you contribute to your TFSA, but the entire amount is tax-free. The entire amount is liquid, and the entire amount, the dividends, the income, the interest, the capital gains, whatever happens in that account goes tax-free perpetuity for your entire life and for the life of your spouse, because you could roll it over to your spouse tax-free upon your death. So it's a pretty neat thing. If you have spare cash, you should be considering your TFSA. So something to consider for their TFSA. I always want to mention it because a lot of people, they don't know if they should contribute to their RRSP, their TFSA. And I mean, if we keep going down this path, what happens on the withdrawals? The entire amount can be withdrawn. And if you withdraw it on December 31st, you regain that contribution room on Jan 1. So the entire thing is perfect for liquidity. That rainy day fund that everyone should have, this is perfect for you to do that. So you build up a sum of money that you can use to either replace 6 months or a year's worth of salary, and it's completely tax-free and it grows tax-free and you can pull it out tax-free. It's perfect. It's perfect for a rainy day fund.
Yeah, I love that you mentioned that because there was just actually Statistics Canada just came out with, they did a survey and came out with some data, found that there's actually a large chunk of Canadians out there in the range of a quarter or something like that who feel as though they would not know how to deal with an unexpected $500 expense. So when you kind of think about that, you might want to consider having that rainy day fund, and what tool can you use for that? So this is where TFSA can be a great tool. People think about it as a savings account, but it's also an investment account. And because of how it's structured, it really is a great option for that slush fund, that rainy day fund, because you're able to shelter that. You're not paying any taxes on that. And then you regain that contribution room next calendar year. So a little bit of a no-brainer if you're looking for somewhere to park a little bit of cash, have it grow as a rainy day fund.
Let's maybe talk about the RRSP rules, how that works, your contribution limits, all that. And then we can get into, should you contribute to your RRSP or TFSA? By the way, if you have questions on this, please keep the questions coming. We're just going to keep talking, but by all means, send us your thoughts, your questions. If you're tuning in on LinkedIn, Twitter, Instagram, Facebook, Pinterest, TikTok, wherever you're watching us, feel free to
I can't believe you know all the socials, Rob. I'm shocked that you named them all.
Discord. I don't know. That's all I got. Okay, so here's how it works for your RRSP contribution limit. You may have seen a chart like this. For 2023, the limit is $30,780. So it's 18% of your income. 18% of your income up to a maximum of. So if you made, I believe it's so it was 29,000 last year. So I believe the limit is like something like 130 grand or something, 140 grand, maybe a little bit more than that. But basically, if you make 150 grand or something like that, you're tapped out. The income you earn above that doesn't garner you more contribution room. So it's 18%. You also carry it forward. So if you haven't fully used up your RRSP contribution, you do carry it forward. You have that RRSP contribution room and you can carry it forward. So couple other things I want to talk about here, or maybe you could cover this if you want, Tanya. But basically, it's how this can be impacted, right? So if you have a defined benefit plan, I don't know if
Yeah. Yeah, so it's definitely something. So when you're starting to make that decision, okay, I have that surplus, trying to figure out, am I going to put this in an RSP or a TFSA? Let's say you've decided you would like that income tax deduction and you've chosen to do an RSP contribution for that reason. Well, you've got to make sure that you're not going over, right? So you want to make sure that you're taking into account, if you already have a pension plan at work, that could be taking up some of your contribution room if it's a defined benefit pension plan. Now, a lot of employers also will match contributions that you make into, let's say, a group RRSP. So that's also going to eat up some of that contribution room as well. So best way to do this is one of two ways. You either check your notice of assessment. That'll have, I forget which line it is on. I should know this, but it will show on there. Another way to do this is if you have an online MyCRA account. There's a little section online that has your TFSA and your RRSP calculations. Just keep in mind that those don't always get updated right away. It should be updated now for RRSPs, but you can actually, I kind of like how they've updated that now, where you can actually click on it and they show you all the calculations for the previous years. So you can actually see what contributions have been calculated and what has been taken into account. And then you know exactly the contribution room that you have.
What do I have next here? I think you guys know how an RSP contribution works, but if not, we should cover it quickly. You contribute to your RSP. It effectively reduces your taxable income by that amount. So if you make 100 grand, you make a $10,000 RSP contribution, you get taxed on the equivalent of $90,000. So what ends up happening is your marginal tax rate on the incremental amount, so from 90 to 100, that marginal tax rate on that amount goes back into your pocket. So the marginal tax rate on that amount, I have a Manitoba tax rate chart here. At 90,000, you'd be at 37.9%. Okay, so you get 37.9% back. And if you make $235,000 and up, you get 50% of your RSP contribution, you get it back. So these are things that that they should be considered, they should be encouraged. And if you are saving and you're not sure where to put it, well, that's a whole other debate. But just to finish the RSP contribution, you defer tax to a lower date. So you get the dollar today. So you put $10,000 in, or you put $1 in, you get 40 cents today. The 40 cents, you could do whatever you want with. You could pay down debt. You can increase your investments. You could go on a trip. You could do whatever you'd like. But those are very, very good, because you get that dollar today and you get it for like 30, 40 years, depending on when you need to pay that back. And by pay that back, I mean draw down on your RSP in retirement, which will be taxable income for you.
So maybe we go over super quick advantages, RSP. So number one, you can reduce essentially your taxable income, which may also reduce your marginal tax rate depending on the size of the contribution. So that's one big advantage there. Secondly, we get that tax-free growth over time as that money is invested in that RRSP. But just one thing to keep in mind on the back end is that that will be taxable income when you start withdrawing that RRSP. And generally speaking, most people will be retired when they are drawing down on that RRSP, so they'll be in the lower tax bracket. So that can work out quite well, especially if you're using other strategies like income splitting as a couple, those kinds of things. So those are going to be kind of your big advantages on the RSP side of things.
Got a question online. So I prepared this from Phil online. So I actually prepared this for Phil. Should I contribute to an RSP or a TFSA? So this has been a presentation I've done before, but I thought I would pop it up for Phil. Ideally, both if you can. So you want to use your RSP ideally when you're a high income earner early on. Now that they have the tax-free home savers account, I forget the exact name of it, but I think it's called
tax-free. Yeah, they changed the name. Yeah.
So like now that you have that, if you're in a low income bracket and you're saving for that first home, those dollars should go to that account. If you're in a high income bracket, you should contribute to an RSP. If you're somewhere in between, you should do some of both. Ideally, you meet your liquidity needs for an emergency fund, and that should be met by a TFSA. So ideally, you have a month, 2 months, 3 months at least of liquidity meaning access to cash that you have that you're able to draw down on. And hopefully it's in a TFSA because it's growing tax-free. So at some point when you're becoming an adult, you're kind of adulting, this should be a goal of yours, is to get a liquidity emergency fund. 3 months of income, 2 months of income, something, just so you have that, so that if ever something happens, you're not literally on the streets. So I would suggest you contribute to that TFSA a little bit over time until you accumulate 5 grand, 10 grand, whatever, some sort of number. And then the rest, you should focus on your RSP if you're a high income earner, because you're going to get all that money back in terms of tax refunds. So I don't know if there's anything you want to add to that, Tanya. Here, I put a little note here that if you're below 50,000 TFSA, it's kind of what I'm saying. If you're making significant sums, you should be focusing on RSP. Sorry, I interrupted you, Tanya.
Well, I was just going to add to that, it's not, the answer is not necessarily going to be the same every year, right? So you also want to take into account any windfalls of income that might be coming in. And on those years, we'll probably be focusing a little bit more on RRSPs rather than TFSAs. So it can be a dynamic kind of living, breathing strategy here over time.
Yeah, I think it can happen in a void. It cannot happen in a void. And that's why this last line here, in reality, it depends on your financial plan, because you may be in a position where you're extreme high earner for a short period of time, and then you're never going to make anything. Well, that puts you in a different tax bracket down the line. So anyways, there's so many different things that could impact your future taxable income, your current income, and then your income splitting in retirement that I think no one has the same picture here. There's no clear-cut answer for any one person that we could just write down. Yeah. So we do our best to kind of summarize it on a slide, but it's a little more complicated than that.
It depends is always the answer, it feels like. But I like that you mentioned the tax-free first-time savings account. I don't even know if I got the name right, because it used to be that whenever we had the question, should I contribute to my RRSP or my TFSA, we would say, well, if it's shorter, medium term, you need liquidity, TFSA. If your income is high, do RRSP. Oh, but the exception is if you want to buy a home for the first time. But now we actually have an account for this. So now it makes answering the question of RSP versus TFSA a little bit easier, because now we really can kind of focus on where the income level is at and then use this account for first-time home buying.
Yeah, and I've summarized it here on a slide for us. So it's a new account. It's called the FHSA in terms of, I guess they just took the T out of tax-free home savings account. For the acronym. That's okay. We can make up rules too.
As first home? I think it's for first home.
First home savings account. Yeah, fair enough. Make up rules as we go. $40,000. You could put $8,000 per year. So 5 years worth of contributions should get you to $40,000. Carry forward applies only if you have opened an account. If you have opened an account, so you don't get the carry forward. The tax, it's like an RSP in that it's tax deductible. And it's also tax-free on withdrawal. So there you get the best of both worlds. You get the best of the RSP in that it's a tax-deductible contribution, and the best of the TFSA in that it's tax-free on withdrawal. Both of them grow completely tax-free inside of the account, and it does not impact your RSP contribution room. There's also no obligation to repay. So this is like a significant step up from what we've had in the past. Unlike the home buyer's plan, you used to like take a loan out from yourself and then you pay yourself back over 10 years or 15 years. But this is an unbelievable shift. And so obviously if you're young and you've never owned a home and you have a goal and aspiration to own a home, this should be your number one priority, period. End of discussion, because you get the tax deduction and you get the tax-free growth and it's liquid and you could pull it out tax-free. So you don't have to worry about, what if I want to buy a house and I'm not ready for it? The money's liquid, so you don't have to plan 10 years ahead of time. And the government really wants you to own that home, so they're giving you the tax deduction. So that's phenomenal. So if you're young and you've never owned the home, it's an absolute no-brainer. However, it's actually also an absolute no-brainer for anyone who qualifies for the FHSA And I believe it's 5 years without a home, I think, or 3 years without a home. I should probably find that out. But whatever the number is, if you qualify, if you've not owned or lived in your own home, I believe it's 5 years, and you therefore qualify for the FHSA, you should unequivocally start one, because you don't have to admit to the government that you have no intention on buying another home. They don't know and they don't care, right? So if you qualify, if you meet the criterion, then you should open an account, because you get the best of both worlds. You get the RRSP and the TFSA. It's basically a souped up, steroided up TFSA RRSP hybrid clone that's just way better, right? So did you Google the definition?
I'm trying to find it, how many years it is.
I know I did a video on this, and I know in my video I had Googled it and I had searched it. But regardless, whatever the amount is, I believe it's 3 or 5 or 2 or 7 or something like that. It's one of those many numbers that I just gave that I don't know.
Maybe Diego can look it up for us and
Yeah.
let us know.
But so it can actually be a great retirement planning tool for someone who's, let's say, 65. They've downsized. They sold their house 5 years ago. Now they're in a condo, or maybe they're kind of in a 55 plus. That's a lively 55 plus. And now they can open an FHSA and tack on the $6,500 in the TFSA, $8,000 in the FHSA. And what they have to do when the FHSA, I believe it's when you're 71, you need to roll that into your RRSP. So you get a tax-free roll, which is perfect anyway. Yeah.
This is the kind of thing that we've been kind of like waiting for. We've been saying, oh, wouldn't it be great if we had all the advantages of a TFSA and an RRSP? Well, there it is. And I did find the criteria. So you have to either be a first-time home buyer, and this is how they define it. You or your spouse or common law partner did not own a qualifying home that you lived in as a principal place of residence at any time in the year the account was opened or the preceding 4 calendar years, 4 years.
Okay, so 4 plus this year, so 5
calendar
years total.
Years. Yeah,
that was my hunch initially. That's what I first said.
It's always 5. Uneven numbers. It's always odd
4
numbers.
Plus this year. So as long as you haven't owned and lived in the home for 4 years plus this one, you can have an FHSA. So something you should consider. Now, obviously, if you're not going to get tax arbitrage benefit from the contribution and the withdrawal, you still benefit from the tax-free compound growth.
As if it was a TFSA.
As if it was a TFSA. So when you're pulling it out, it's going to be taxable like an RSP. So I would just review that with your financial planning expert, ourselves. Go to www.speakToRob or www.speaktotanya to book a no obligation consultation if you're not sure if you should. But it's certainly something that we're seeing. And then I see a question here from Lucette. Can a parent open and contribute to an FHSA on behalf of their child? So you can contribute. A parent can gift their child money to contribute to a TFSA, an RSP, or an FHSA. The government has no issues with that, but the account would be in that child's name. So you could assist your child opening an account, but they would have to be an adult child. And you could gift them the money, or you can make the contribution online. But I don't believe that you can open an account for them. It's not like an RRSP where you are the custodian, you are the trustee, if you will, of the account. This is in the adult's name. So thanks for asking that question, Lucette. By the way, keep the questions coming if you do have questions on anything that we've talked about today, on the retirement, on RRSP, on TFSA. A couple other things that I wanted to talk about. Quick gear shift. The RRSP, this one still applies, so I'm just going to pull this up. Your RRSP eligible room is $2,500 to maximize the benefit. It's $2,500 per year per child. So if you got 4 kids, you could put $10,000. They're going to match 20% of that up to a max of $8,000, I believe, is the max grant that you could use in your life. Max contribution was $50,000. 7,500. 7,500.
Yeah.
Make sure you contribute before your kids are in high school, because if they're turning 15, then you're kind of restricted. I then want to talk about some of the benefits, or I don't know, maybe you want to talk about this, Tanya, but this is just some if anything has changed. And this slide right here, the clawback number has changed for the 2023 year.
I'll let you talk about this one.
Sure. I'll cover this
tiny
quick.
writing here.
Yeah. So the OAS, this is the old age security. So if you're making too much money, they claw you back. So in retirement, we all get an old age security, which is like a pension benefit, but we lose it if we make too much money. They start to claw back at $87,000, and they're completely clawed back at $142,000. So if you make between 87 and 142, you will receive a partial old age security check on a monthly basis. But if you receive more than $142,000 in salary, you do not get it. You do not get the old age security pay whatsoever. It's fully clawed back.
And this is for individuals, so very important to start thinking about things like income splitting and all of that.
Yeah, this is why we always preach income splitting. Have you considered this? Are you factoring in that you can split your pension income, your RIF? Have you optimized your tax efficiency in your non-registered investments, right? Are you investing solely in interest-bearing instruments, which are adding to your taxable income? These are all things that your advisor and your planning team should be discussing with you and should be taking a look at. The guaranteed income supplement, this is the supplement that you get if you're lower income earner. It's cut off at $20,832 this year. So, and also you do not receive the OAS pension. The cutoff is $49,900 for the combined income. So these numbers changed a little bit. I just wanted to update you guys that for 2023. Other limit changes for 2023, the lifetime capital gains exemption. So this is if you sell a business. If you sell a business and you have qualified shares that are sold, you get to exempt a capital gains exemption on the sale of that business. So if you own a campground, a plumbing business, a manufacturing company, and you sell the shares of that company, the first $971,190 are tax exempt. And if you have a spouse, you could both exempt that. And if your kids are active in the business, they can exempt it as well. There is a test now that needs to be met. You need to be active in the business in order to qualify for the capital gains exemption. Now, you could get a family trust set up, which could allow you some a little bit more favorable treatment. But I did want to share this with you as well.
All right. So hopefully, let's see if we have any more questions. If you have any questions about any of these accounts, doing contributions, taxation, deadlines, please go ahead, drop those in the comments for us so we can help you out here with your questions.
Do you want to talk about the market quick? Just kind of give an update to what's happened kind of over the last month and a half.
Well, after quite a volatile year in 2022, we had quite a bit of a rally in the first month of January, but there's still a lot of talk, still inflation. We're dealing with inflation, high interest rates. So I'd love to hear kind of your take on all of this. I know that from our perspective, we're always thinking of our clients' future in the long term, right? We're kind of thinking big picture situation. We expect that there will be recessions that will happen every, X number of years, 5 to 10 years. We know that market cycles, around 4 years. So we know that we're going to see dips like this, and we know that we expect that these companies will be profitable and that things will come back and that we're going to hit some all-time highs. But the question is always when. And sorry, guys, you're not going to get an answer from us on the when. We don't have a crystal ball.
I think I love how you put that, Tanya. I think that's very good. And when you talked about the rally so far this year, if we're looking at the TSX today, we're up 6.6. The Dow is up 2.4. The S&P is up 7.5. NASDAQ is up 14% year to date. So that's the tech stocks. I think Facebook's up 50%. Tesla's up 50%. Even the cryptos that had been completely written off, Ethereum up 50, Bitcoin's up 50, 55. A lot of the tech companies, they're rallying this year. Shopify's up 52. The problem for a lot of those companies is they were down 60, 70% last year.
That's
so
right.
But
But the good
that's
thing
the
is this
NASDAQ.
earnings call has been pretty good. I mean, we've been seeing some reasonably good numbers on the tech side. Some of these tech companies had to do more layoffs than others, but now they're kind of looking towards the next couple of quarters to kind of have their, economic recovery plans. And so we are seeing some good numbers. It varies, of course, from company to company, but I think that it's given investors some hope that that there's plans in place to get the economy back. And so even though we're still hearing a lot about inflation, we're also hearing that things are moving and changing, and that these interest rates are having an impact finally now on the bigger macro climate.
Absolutely. And it's the high betas that are moving the market right now. Like if you look at anything that got killed last year, it's just a good reminder is why we diversify, right? Because we had energy, oil and gas stocks in our portfolio last year. Some of our clients had some. Those did really well last year. Well, they're not doing great this year. They're flat. But if you have the tech this year, or some of the higher beta stuff, the stuff that got killed last year, that's recovering this year. And we always preach that like diversification is more than just stocks, bonds, alternatives, right? It's in your stocks. Do you have Canada? Do you have US? Do you have global? In Canada, do you have consumer discretionary, consumer staples? Do you have value? Do you have growth? Do you have stocks that are underpriced, overpriced? Do you have stocks that are in sectors that have historically done well, rebounding, and some that haven't, others that haven't? So we look at all that, and this year, the last 2 years has been proof as to why that makes sense, right? You look at companies that are doing well this year. If you had a portfolio that did phenomenal last year, like a company like McDonald's is flat this year, but a company like Carnival, the cruise line, they're up 50%. Well, it wouldn't have been good to own Carnival last year. McDonald's would have been a much better stock, but I digress. This
is where this idea of, we preach diversification, but this idea of having different holdings that are uncorrelated, right? That's where you really start to be able to kind of have some tools to protect from potential downside in these kinds of economic conditions.
Yeah. It's why we're good at what we do, is that we remove emotion, we find uncorrelated assets, and we protect the capital by having a portfolio that's built with a bigger purpose than just jamming stuff in there, right? It's got a purpose, which is, okay, we're going to protect the downside. We want to generate risk-adjusted returns. We want to have the least amount of volatility possible for this client. We want to be as tax efficient as possible. And when you put all that together, you end up building a portfolio that's done really well over the last few years, and it's super tax efficient, and clients are happy. So we're pleased with how it's gone. So you talked about how we're not gonna give them an update as to when this portfolio might turn. I am confident that 2023 will be a very good year. I'm extremely confident in that. It might take 3 or 6 months. This recession that might happen, if it happens, it's going to happen in Q1, 2, or 2, 3, right? If it happens, it's going to be now.
Yep.
But mind
and
you,
we talked about this last
numbers.
month too, how the markets tend to be a leading indicator versus the recession kind of being more lagging. So
6 to 12 months, right? 6 to 12 months on either side. So
when you take that into consideration, from a probabilistic perspective, we can imagine that the turnaround, chances are pretty good that it should be the next 12 months or so.
Yeah, I think before that. But yeah, I think we do have to be conservative when we tell people, so that, what is it? Under deliver, over promise. Under promise,
over deliver.
That's the one. Yeah. That's
under promise.
Not the other one.
No. But yeah, it's for those investors who are kind of watching the markets, or have been watching the markets over the last, let's say, like 6 weeks. Wow, it's a little bit of a roller coaster ride, but encouraging to see that some of the stuff that got hammered last year is starting to come back. So
yeah, and expect volatility. I said that last time, but like the VIX is still hovering at a pretty high number. So that means, what are people paying for volatility right now? It's a measure based on the options, right? How options are traded and what kind of premium the time duration of options are awarded. So right now there's an expectation of volatility, and it's not gone away. So the entire month of January, December, The VIX has hovered around 20 and we're still around there. So there's still this perception that the market is volatile, and the market has been volatile. So I don't think that's going away soon. I don't think we're going to see like a 13 or a 14 on the VIX for, maybe a couple months for sure. 3-4 months maybe. But I think it's coming at some point.
Yeah. I thought for sure people would want to hear all of our predictions here. Any questions coming out of this? Looks like people prefer to talk about, lots of big picture stuff than TFSAs and RRSPs today. Not quite as many questions as usual. Keep them coming, guys. Come on.
That's okay. I mean, if we're not having any further questions on TFSAs or on RRSP or on the markets generally, we could wrap it up. We did want to give everyone the information, the very relevant information. It's 2 weeks away, the RRSP deadline. If you're a client of ours, call our office. We can send a courier to pick up a check. We can do electronic transfers. We can do it by signing forms now. There's a whole bunch of ways we can do it. So you could do that. If you're not a client of ours, well, what are you waiting for? Time for you to reach out, book a no obligation consultation. We'd love to chat with you or about anything in your portfolio, tax efficiency, contributions. Likely portfolio construction is probably what's on your mind at this point. And we'd be happy to chat with you about that. And then I guess also want to, excuse me, Tanya, I'll let you handle this.
That's okay. Well, one last heads up, Run with Rob. That's the other place we'd like you to check out. Next time we do a live, maybe we'll tell you how our training is going for that. We'd love to have you join on that. So, perfect. Thanks, Diego. You got the website on there, www.runwithrob.com. And of course, if you want to chat about your investments, your financial situation, speaktorob.com.
www.speaktorob.com, www.speaktotanya.com.
That's right. Or robtater.com or tanyatater.com. So there you go.
You could find us on the socials. And don't forget to like, subscribe, and smash the bell to be notified when we put out new content.
Have a great week, everyone.